I think what we've been seeing over the last 2 weeks has been absolutely breathtaking, to be fair. I mean, if we're looking at what we've been seeing in terms of the trading environment, the investment landscape, it literally has changed 180 degrees on a dime. I mean, back on the 9th of March, we were pricing in 27 basis points of tightening in the Fed between May and December. Now we're pricing in nearly 100 basis points of cuts. I mean, that's a dramatic move. And of course, we've seen the 2-year Treasury dropping from around 5% down to about 3.97 at the moment. So that's obviously a big, powerful move in itself. But I think that dispersion now between year-end pricing at 3.93 and the Fed funds market effectively and, the Fed's dot plot. So it's a bit wider differential as we've ever really seen. And I think that's telling you a powerful message. But I also think that the market has become far more sensitive to banks. I mean, everyone knows this situation that, as soon as the KRE sells off or the XLF or the KBW banking index sells off, we see, rate cuts being priced in and the dollar sells off and we see traders looking to buy gold as a hedge. But I think what's now changed is those banking risks and what's happened pays so much more attention to markets. 2 weeks ago or so, we were just really focused on terminal pricing, peak pricing, and that meant looking at payrolls and the average hourly earnings and also the US CPI print. They're still not going away. They're still things that are going to be very much influential to markets. But now we're also looking at things like the NFIB Small Business Survey that comes out on the 11th of April. We're looking at deposit flows into money market funds. We're looking at any kind of data that we can get our hands on around credit, so both the supply and also the demand. And those factors are going to move. But for now, when you're seeing that trade, if banks lower, the dollar weaker, people moving their money into other jurisdictions and people pricing in a higher risk premier is obviously something that's going in there. So I think it's just this idea now that there's this massive dispersion between Fed pricing and where the market's pricing is one thing. But I think the sensitivities and the interest of the markets have changed as well. Markets are trying to price risk and they're struggling, and that's causing volatility.